uses of an income statement. Now that you have one, you've calculated one, you got it all prepared, usually you paid someone else to do it for you with an accounting system, or maybe you've done it yourself. And what you want to know is your profitability. And often what you do is you normalize it for the size of your business to see if there's an efficient use of the resources. You might have made an income statement that says you made $10,000. That's great. Is that from $1 million worth of assets or $500 worth of assets? That makes a big difference. And so that's what we mean by normalizing by the size to see if there's an efficient use of these resources. So we've already kind of alluded to this already. Net farm income from operations and net farm income. They probably should be accrual adjusted if you want to think about it, but you don't have to. Most people don't. They usually just use it with my net farm income in 2019 based for my 2019 taxes. That's what they would use. And then we calculate these rates of return. Rates of return on assets, rates of return on equity, and then there's an operating profit ratio or a profit margin. And we'll go through each of these measures and how to calculate them specifically. The big question, though, is, okay, revenue. It's your income statement. You decide which non-cash sources of revenue to include and whether it's accrual adjusted or not. That's your decision. Selling things is self-explanatory. I'll let you deal with how you want to do your selling capital or non-current assets for prices different than their basis. Is that you can treat that as revenue or not? Are you going to do accrual adjustments? That's your business. But you at least understand the principles. And if you're hiring somebody, you can have him or her do it the way you want them to do it, or take what you have and make adjustments for these kind of non-cash revenues. It's up to you. Same with the costs. You have to decide what non-cash costs to include or how to include them. Do you want to do it, depreciation, for example? How you decide. And again, do you want to do accrual adjustments? Again, it's a discussion with you and your tax or your accounting person. The big one in this cost is you have to pull out interest paid on capital borrowed, on borrowed money. That because it becomes a big difference between return on assets, return on equity. Is you need to know interest interest paid. It's basically it's for you as an expense. For somebody else that provided the equity that it represents, that's their return on their equity that they gave to you to use. The other one you have to calculate or estimate is unpaid labor and management. It's how much you're going to pay yourself. You're going to decide. You need to account for it in some of these measures, and you want to think about it as, do I pay myself for my labor and management, or do I roll it all into labor management and investment as an investor? And then you're going to have to answer it to yourself. Are you going to do accrual adjustments? You decide. So let's go through these formulas quickly here. Net farm income from operations, revenue minus operating costs minus interest. Operating costs are all those expenses, cash and non-cash ones you decide to include. And I've separated interest out from all those just because we're going to need to account for it later. It does not include investment income from the sale of capital assets. Depreciation should already be included, though, as a cost of doing business, a non-cash cost in your operating costs. It does not include paying the operator manager for their time and labor. And so unless that is somebody like you hired somebody to do that for you, that's the way. If it's just you and you haven't expressly paid yourself or explicitly paid yourself as part of hiring yourself, then just note that it doesn't include that. So net farm income now is the same beginning part, all the revenue minus those operating costs and minus that interest. But now you've got the unpaid labor and management, what you actually pay for yourself, what are you going to put it down on, and capital gains. And so the notice here is that it's from the whole business, both the operations and the investment activities of the business. And this is where net farm income from operations is the returns from working on the farm and being the manager. Net farm income also includes the labor management and then returns also from your investment activities. So I like to think of those as the three hats the farmer wears: labor, management, and then investor. And so net farming income from operations is your returns from labor and management. Net farm income for the business, that's your returns as labor management and investor. When you've paid yourself for your labor and management, is there any money left over that you make as an investor in the business? That's what net farm income captures. Is after you paid for your labor and management, how much money do you have left over? Accounting for all the revenue and operating costs and your interest, and then any capital gains. So The other way you can shorten up down there at the bottom, it's just what is net farm income? It's net farm income from operations minus that unpaid labor and management plus your capital gains. So you can see there's two ways of calculating it: the long way, or just take net farm income and add that, subtract off labor and management costs for that you haven't included, and any capital gains. Essentially, you've seen this part here, and it's essentially that's what you're making the distinction between labor management, and investment, and you want to net those all out. Return on assets is essentially net farm income, but adding the interest back in. It's revenue minus the operating costs, minus unpaid labor and management, plus capital gains. So it's all the returns on the assets, but so it's your old net farm income, but you add the interest back in. It's the income, the revenue, the income, the net income generated from all the farm assets, including your investment income. You basically don't subtract out the interest cost, because interest is a cost of the business that you paid as all the assets. It's a cost of using someone else's money, so your farm can have more assets than just the ones you own with your equity, and that's a cost of doing business. So in essence, it gets added back in as a total cost instead of an operating cost. Another term it might be used is return to capital, but it's revenue minus operating costs minus unpaid labor and management, adding capital gains, or net farm income plus your interest. And notice it uses an unpaid labor and management. That's an estimate. What would it cost to hire somebody to do your job? That's the one way to think of it. Like you had to replace yourself. Say you decided to take a different job and you had to hire someone to do all that for you. That would be the way to think of it. The next one is you might use an opportunity cost. I like doing what I'm doing, but if I quit and took this other job, what would they pay me? That could be your unpaid labor management. It's actually arbitrary because most farms don't account for it if they're like a sole proprietor. They work for themselves. But it's an important one. It's gonna, whatever value you're going to choose is going to affect your return on assets. And some organizations, multi-generation farms where there's parents and grandparents and children all working together on it, or two brothers or something like that, they could easily have this labor management to hire themselves as salaried employees for their operation. They might actually do it explicitly, like if the two brothers are farming together with their families, they both pay themselves. They create a company, brothers family farm, and then they each pay themselves, make up a number, $75,000 a year for labor and management. Maybe one of their spouses is paid as well as something else, maybe as labor or something like that. Things like that is how it's done. But a lot of people, what I'm trying to say is some operations, it's an explicitly paid cost, and other ones, it's not. And then you have to come up with some way to do that if you want to try to calculate your true returns on your assets. If you ignore it, which most people or many people do, you'll get a higher return on assets. It's just up to you to decide how to deal with it. It's basically, the one thing is if you can compare your return on assets to other businesses and other farms, make sure you both have done it the same way, or you've adjusted it somehow if you don't and they do. Same with that other business, a company. If you want a return on assets of, say you get a return on assets at 20%, but then you realize you haven't paid yourself labor management, and you compare that to the market. Well, the market rates of return on assets is going to be lower because they do pay for their labor management of all the people working for the company. So it's not really a fair comparison to compare yours without taking that out versus somebody else's who have included it as a cost. So once you have the rate of return, or after you have the return on assets, you calculate the rate of return on assets. It's just normalizing for the size of the business. It's creating a percentage. I've got an X number of dollars. I used that example earlier of $10,000, but is that on $5,000 worth of assets or $500,000 worth of assets? $500,000. Well, that's what we're looking at here. So all you do is you take your return on assets and divide it by the average amount of assets over the accounting period times 100 to get a percent. A lot of people like to use that average, particularly if there's some large swings in value of the assets. The balance sheet's on a specific date, whereas the income statement's over a longer period of time, often a year. So some people use the average of the beginning and the ending assets as the average assets over the period. But if it's not changing very quickly, then it doesn't really make much difference. But here for this course, we'll use it as the average of the beginning and ending. So you go to the balance sheet, get the average of the total assets, current and non-current, at the start and at the end of the period. And that's why you combine these two. Once you want to get these rates, that's why you combine the balance sheet with the income statement. Then you can calculate these rates of return. Then the other big question is, okay, we talked about on the balance sheet, which basis are you using? The cost basis or the market basis? You're going to get different answers for your rates of return on assets, depending on if you're using the cost basis or the market basis. If you want to do the market basis, that's going to allow you to compare farms to other farms and to compare your liquidating and getting your market rates return on your financial investments. If you were thinking of it as, I've got a bunch of money, I'm investing in the business, how's this business doing? Then you'd use the market basis. But if you want to look at your trend over years and adjust for the market return on assets that you get, if you do the market basis, you're going to mix all your sources of returns, including asset valuation changes. So you're going to capture some of that investment return on assets. The cost basis would be your return on assets or the rate of return on your assets as a manager, where you don't capture that asset value changes due to market prices going up and down. And so it's a better way to do it over years to capture your trend. Am I a good manager? I might be making money because my land value is going up, but I'm actually, if I use a cost basis, I'm realizing my rate of return is not that great. I'm not that good of a manager, but I happen to be owning some land that's going up in value quickly. And vice versa. Back in the 80s, the land values are going down. And so you wanted to separate, am I doing a good job managing versus once I account for the fact that my assets are declining in value, I am losing money as a business, but it's not because I'm a manager that's poor. It's because the land I'm owning, my major assets are going down in value, and you're separating some of those out. And the rates was when you do the rates of return. The last thing, so basically, if you're going to compare between different businesses, you want to make that adjustment. Make sure you both do the cost or market basis and understand the difference. You also don't want to include non-farm assets and income. Sole proprietors, everything gets mixed together sometimes. The farm truck is used for personal use. The personal use payments, you might mix in your personal income and all that kind of stuff. And so you want to, if you really want to do it right, you would keep the non-farm assets and income out of the farm analysis. Okay, the next one is return on equity. So it's revenue minus operating costs minus interest, minus unpaid labor and management, and capital gains, or return on assets minus interest, or net farm income. And so it's just the income generated by the farm assets is all the income. That's return on assets. It's really, think of all that income generated by the farm assets. Return on equity is the part that goes to you as holder of the equity of the business. It's your return in dollars on the part you own, not the part that might be owned by the other equity providers, lending institutions, banks. It's the part of so you have a farm worth $1 million, you own 75% of it. What's your return on that 75%? Here, $750,000. Then you can calculate the return on that, and then next thing will be to do the rate. So what's the rate of return on equity? It's the return on equity divided by the average equity. Again, I use the average from the beginning and ending, just in case there's a rapid increase or decrease in equity due to asset price changes or other issues. And you get it from the balance sheet again. It's like the rate of return on assets, except you're using the rate of return on equity so you're using ROE instead of the ROA. And essentially, it's just interest it's the only difference between the two is interest. And the interest is really the lending institutions, the bank's return on equity. For you, it's the money goes out. So the bank's return on equity, rate of return on equity is their interest rate. And you can kind of see quickly then, the only difference between these two is the interest rate. And so if your return on assets is above the interest rate, that means your rate of return on equity will exceed the rate of return on your assets. It means you're beating that interest rate, the market. You're doing better than the bank thinks is a good market return on those assets. They gave you $1 million, they gave you $500,000 to buy the farm, and you're earning more than the 3% they charge you for that asset. That's great. You're beating that what they thought was a fair rate for the level of risk and everything. Same thing. If they're charging you 3% and you're earning 1%, you're not beating the market. Your rate of return on your equity is lower than the rate of return on assets. And so you can kind of see that's the interest rate. It's a good way to differentiate. How am I doing the lending institution, the stock market, whatever, thinks this is a traditional rate of return for these kind of assets, for this kind of risk. Am I beating it or not? Hopefully over the long term, you're a good enough manager and invest in the land, everything, you are doing better than that, but not always. And we'll see eventually there's a lot of fluctuations in agriculture. The last measure is the operating profit margin. I always call it the profit margin. Essentially, it's return on asset is your return on assets is your profit, and then you divide by the total revenue. So you have a total amount of revenue come in, then you subtract off all these different costs to get the return on assets to divide by the total revenue. I'm going to give you a percent. So of all the revenues generated by the business, how much does the business keep? Not the equity owners or the banks or anything. It's just the business. If you have a low profit margin, you probably want to improve it first by lowering your costs before you think about expansion or anything like that. Or you need to be a better manager, figure out what am I doing wrong. Do I need to get better prices from things I'm selling, or I need to be reducing my costs. I'm too high cost. But if you have a high profit margin, maybe expansion does make sense. You're earning 30%. Well, maybe if your profit margin is 30%, maybe it's like, I could add more. I can add more acres, add more cattle, add more cows. So that's kind of a quick overview of all these. They're all listed here. The formulas are right there. For the class, you'll be able to use these, the sheet, if you will, to calculate it. But we'll get some examples and you'll work through these on a problem set and everything. But you can see there's your farm summary of all those definitions are all laid out. The last comment I'd like to do is just any small business, any farm that does their accounting or pays, more likely pay someone to do it for them, they're going to calculate their farm income. They're going to do it for taxes, but they're going to have to decide if they're wanting how to deal with these non-cash costs and non-cash revenues, things like depreciation, inventory changes, accrued expenses and prepaid ones, and making accrual adjustments or not making them. Are they going to formally think of it as unpaid labor management for themselves and their families? Are they going to take care of all that stuff? That's their choice. But now in this course, you've been exposed to it enough to know what the issues are, and you can decide for yourself or have a discussion with your accounting firm, whoever you're using for your accounting, and then they can help you make some decisions about what you want to do. The big one is if you're comparing farms to one another, you got to make the same assumptions about some of these big things, the same non-cash costs, the depreciation is handled the same way, and et cetera. So to make fair comparisons. So we've gone through all this stuff, how to develop an income statement, talked about accrual accounting versus cash accounting, accrual adjusted cash accounting, talked about how to calculate net farm income from operation, these rates of return on assets and equity, and the profit margin. We've looked at, now I want to look at example rates and